Hello everyone. Today is Friday, May 20th, and this is your USA Gold Weekly Review and Outlook. Both gold and silver were under pressure this week, down a little bit, mostly stemming from the release of the Fed minutes and the rather hawkish tone that they took, essentially putting June back on the table for an interest rate hike, which we intend to talk about. We've been down this road countless times, but here we go again, Pete. I mean, I guess I'll believe it when I see it.
Don't make me talk about the Fed again, Jonathan. Good golly.
I know, right?
Right. Same as as it's ever been. You know, it's the rise and fall of Fed rate hike expectations. It was widely believed that June was off the table, and that was reflected in Fed fund futures, which put the odds at about 4% before the kind of after the actual April FOMC statement came out. And then 3 weeks later, the minutes come out, and suddenly everybody's like, oh my gosh, the Fed is hawkish.
Yeah, decidedly different.
So what I find interesting is that if the Fed really wanted to convey optimism about the U.S. economy and the possibility of a rate hike as a result of that, why wasn't it in the statement?
Exactly. It doesn't make a whole lot of sense.
No, it really doesn't. And a lot of it is what the market latches on to.
Right.
And so the minutes reflected, basically said that a June hike would be appropriate if the economy continues to show signs of improvement and higher growth in the second quarter. Yeah. And I think everybody had always believed that we were going to get better growth in the second quarter than the dismal first quarter that we had. But there were people at the FOMC meeting, and it's reflected in the minutes, that had some qualms that they didn't think that there was going to be enough information to raise rates. But the market seemed to ignore that line and focus instead on June would be appropriate if.
Yeah.
If.
I know, the qualifier always appears to be ignored in my mind, and it's hilarious. But even still, Fed funds still haven't even priced it in as a probability at this point. 30%.
No, 30% for June and 55% for July right now. So we used to have to look all the way out to December to get better than a 50-50 chance. So suddenly there's slightly better than a 50-50 chance as soon as July.
And I guess there's some broader context in that making some sense where, and I've read this, where if they're gonna do it, they're probably gonna want to do it far enough in advance of the election, so they don't do it right on the eve of the election, like at the September meeting, for example. Right. And so I think that's part of why June and July have jumped back into the conversation here. But the qualifier is there, and the big retail sales, the Targets, the Home Depots of the world, they're both projecting poor second quarter results. And so, or underperforming, and so you've got a lot of the headwinds that had never went away, and just I guess were somewhat ignored in this statement. But it's the classic cyclical nature of what the Fed does and how the market reacts, and it's almost reached the point of comedy. And actually, I'm going to throw up we'll call it a flow chart from Bank of America Merrill Lynch, because I think it's it's pretty funny and it really points to what it is. And so this flow chart's up now. You're looking at it. Fed threatens hike, markets tank. Fed delays hike, markets recover. Fed threatens hike, markets tank. Fed delays hike, markets recover, and on and on and on. Right. We go around this merry-go-round. But the reality is that it is just all talk. And I think what the market has begun to finally do, thank goodness, is ignore it a little bit. Not put so much credence on just what the Fed says and start maybe looking more at what they do. And I think that that's what's happened with gold, is that, here, always in the past, when they would trot out raising hike, rate hike possibilities, gold would really struggle. But yeah, gold saw a flash lower, but this is already after, there was a big short put in the market earlier in the week, and it come down to about 1265, that's support level. Currently trading about 1250, so we're down 1%-ish on this whole Fed hike. concept and this whole June being back on the table idea. And so gold is beginning to ignore the Fed a little bit.
Yeah, it's really disproportional in terms of the jump in rate hike expectations reflected in Fed fund futures versus the actual reaction in the gold market. As you said, the real reaction is only about 1% lower. Even if you take the May high, we're only about 4%, less than 4% lower from the cycle high.
And so gold is shrugging it off, which it ought to, because if you look at what happened back in December when they did raise rates, the things that got clobbered were stocks and oil, and gold went up $200. So, exactly. I mean, even the premise that gold would go down because they're going to raise rates in June is a little silly to begin with, but that's a whole other story, one that we've covered many, many times before. But moving on, I want to talk about George Soros a little bit, just because George Soros released his holdings, basically had his mandatory filing released earlier this week, and in it, he showed that he had taken a pretty big position in the gold ETF and a pretty big position in Barrick Gold stock. This is interesting and important because many of you will probably remember that Soros was the quoted darling of the gold bears when gold was about 1,700, calling gold the ultimate asset bubble. Now, granted, he was, in my opinion, taken out of context in that quote, but by the time it got re-quoted 15 times down the line, the context was long since lost. Really what he was doing is he was proclaiming that gold would be the greatest asset bubble of all time. But at the time, he was out of gold, and so there was some thought there that he had pulled his position and everything, but then to see him jumping back in, what's that say about that comment, the context of that comment, and what's it say about the gold market, Pete?
Well, we spend a lot of time refuting the concept of gold being in a bubble just simply on allocations. I mean, the reality is that most people weren't even remotely allocated to the gold market at the time, despite the big run-up in the price during that time frame. So it was very unlikely that it was anywhere close to a bubble. We've since seen a correction, and I think George Soros, who is a pretty noted trader, sees the opportunity here.
Yeah, exactly. And I want to highlight that even further in context, defining what a bubble is and versus what just a normal market pullback is. And gold had a very classic 50% retracement of its gains from 3 to 1900, basically down $800 from the highs, and now is showing a lot of recovery. That is not a bubble bursting. That is a normal market pullback in a normally and rationally behaving market, which if I'm an investor, I want to put my money in a market that's behaving rationally. Right? And so now Soros jumping on board, though, there is an element of a confirmation that comes from that I think is worth noting. And just to finally officially pull away this notion that gold is the ultimate asset bubble that so many of the bears, were so quick to hitch their wagon to, so to speak.
It was nonsense then. It's certainly nonsense now.
Means such now, exactly. So with that, we're going to move to our golden gong, which actually speaks more about the Fed and in our opinion of what the Fed is doing. This quote comes from Douglas Borthwick. He is the New York-based head of currencies at Chapdelaine & Co. Sorry if I butchered that. A unit under the British interdealer brokerage Tullett Prebon PLC. He writes, "The Fed is in a bind. The Fed can't raise rates because it means a stronger dollar and it means deflationary pressure in the world. The Fed's under pressure to talk a mighty game, but it can't actually do a lot." Exactly what we believe. Thank you very much, Douglas. For you, the Golden Gong. Thank you very much for watching. I'm Jonathan Cazares.
I'm Peter Grant.
See you next week.